We're joined by Jay Flaherty, Chairman and CEO of HCP. How do you feel about the state of your company's balance sheet at the moment?
Well, we're very fortunate. We've got a $1.5 billion line of credit that's got a couple more years before it matures. We have nothing borrowed on that whatsoever. Were we to do so, our incremental borrowing rate is at LIBOR plus 55, which in light of the current economic environment is very, very attractive. In addition, we're sitting on between $300 and $400 million of cash and liquid marketable securities. And then the leverage ratio that we have in our company is at its lowest point in 6 years. So we've never been more conservatively capitalized in the company's 25-year history than we are today.
And what do you consider to be some of the major macroeconomic factors and challenges facing your sector going forward?
Well, I think we're a little bit of a contrarian play on the economy. If you take a look at the sectors that we're in, from smallest to largest, there are hospitals, skilled nursing, medical office, life science, and senior housing. And if you look at the income statements on all those companies, by far and away, the single largest expense item on those income statements is labor. So, notwithstanding the ills that are associated with an unemployment rate that has now come over 10%, is likely not to go down anytime soon, that is resulting in the most favorable labor environment for our operators. Read that to mean low wages, and they've actually been able to manage through this last 12 to 15 months quite well by dealing with revenue pressures by having a more than offset with respect to lower labor costs. So, that's good for our portfolio. That's why you see our coverage ratios actually increasing. The other thing that's out there that hasn't been finalized yet is healthcare reform, and how that shakes out, if it shakes out, when it shakes out, that'll reorder the deck chairs in our industry as well.
And do you see your company going into acquisition mode, so to speak, in 2010?
Well, we've been in acquisition mode for the last 18 months. Again, we've made about $1.6 billion of investments. They've all been debt investments. We felt that was the better way to play this cycle. It's by buying into debt positions at very significant discounts in companies that have reasonably good exposure to the Medicare program.
All right. Well, thank you very much for joining us.
Okay, thanks for having us. Take care.
For more information on this and other REIT news and analysis, check out REIT.com.